Now, I know I'm not the only one that remembers this, right? When I was growing up, I loved those Timex commercials, right? Remember, it takes a lick and it keeps on ticking. This is Rocky Marciano. Now, I don't go back that far, but again, he's punching the bag. It's waterproof, it's shock resistant, it's dust proof. You can't break one of these bad boys, right? And it popped in my mind as I was reading the notes of my next guest. I want to bring in now BDA Capital Partners, Barbara Doran. And Barbara, let's talk about this, right? The recent lickings, because this market takes these lickings, they took them in April, came off the canvas, never looked back, and then recently in the last couple of weeks, again, you've had the China trade scare, regional bank scare, obviously valuation frustration never leaves, particularly, old school investors. How do you account for this?
Yeah, it's interesting because I think the valuation frustration is really the key thing because the market S&P 500 right now is trading at about 23 times forward earnings. That doesn't leave a lot of room for error. But I think the key thing is keep your eye on is earnings. We're just starting the earnings seasons. Right. We're maybe 15-20% into it. 87% of companies are beating. Estimates in the aggregate are 9%. And certainly we've seen some disappointments, but it's really coming in line. And the Fed is really, it looks like next week is going to be their second cut, about 100% probability, and near 100% probability in December. So we're on an easing cycle, and those two things are critical. And
that kind of can help supersede or ease these kind of occasional shocks, for lack of a better word. I did a piece on Monday with the 23 times, and a year later, it's been up more than it's been down, and it's been up as much as 40% and down as much as 25%. So, again, no one ever calls it a timing mechanism per se. What about this sort of notion? Okay, you want to be in tech, but maybe not in the Mag 7 anymore. Like all the action is moving away. I started the show showing AI semis, AI. There's several layers of AI that are really doing extraordinarily well.
Right, and that's the three areas. That's the semis, you've got the energy plant, and the data centers. But see, those are long-lived. This is not over in the next 6 to 12 months. That's going to have extended period. But the problem with these stocks is they occasionally get ahead of themselves. People then rush and move into other stocks. But it always comes back to this because the earnings are real, the growth is sustainable. So I don't think the leadership's over yet. Right. They just occasionally take a risk.
Right, and you don't have to be a chartist to see. It's above these key moving averages, and it just. It doesn't stay down long, right? Buyers show up. But, if there is talk about rotating a little bit, I think, to your point, earnings may be the driver of that. Alcoa out today, up 15%. And again, it's remarkable because they said, listen, tariffs were an issue, but the broader economy was better. Same thing General Motors said. General Motors up 15%. The last time that happened, General Motors went up 160% the year after that. So, earnings, is that really going to be the difference maker here? Well, along with the Fed.
Right. Well, I think for GM and AA, there's different stories there. GM and AA are both very cyclical, and GM's had a whole host of other problems, and all the tariffs.
Right.
And we've seen the administration is backing off on some of that, particularly with the autos, reducing tariffs for 5 more years. Alcoa is really a cyclical play, and that's been a play on the world economy. So that one, and that's what's looking good. Very promising what it reflects about the markets and the economic outlook.
Small caps, I've been trying to get someone to buy them on the show. Everyone keeps saying no. Now I can add you to the no list. Even though the Russell versus the S&P took off like a rocket recently, but now it's coming back down, and we've had these head fakes over the last year anyway.
Yeah, well, that really small cap typically when you're starting an interest rate cutting cycle, that's when small cap outperforms because they think, okay, cyclical, the economy's going to improve, but small cap, I would be recommending you take the small cap is up, the Russell 2000, almost 38% since the low in April. But you've got a couple of problems there. 1/3 of the Russell 2000 don't make money. And typically their cost of capital is much higher than the return on assets. And also these companies don't have the scale to be participating in AI in any meaningful way. And we know what's going on in this country, and all over the world. But basically here, it's going to be big productivity improvements coming over the next year or two.
They're going to miss out on that, you think?
I think they don't have the money in general. Again, you're speaking very broadly about small cap, but you don't have the resources to do that.
Now, I know your main investment theme is right now, don't move away from what's working. All right, but if you are looking at other additional areas, T-Mobile, Netflix, and Starbucks. Netflix has had their report. Maybe it was down a little bit. Nothing to be concerned about. But I'm really interested in Starbucks because I've been looking at this as purely from a management point of view.
Right. Well, Starbucks, in a way, is almost like Nike. Both, had been high-performing stocks and companies for years, and then both lost their way. Nike, you've seen what's happening there, and their turnaround. Starbucks hired one of the best in the business, Brian Niccol, who had really turned, things at Chipotle when things got bad.
And Taco Bell before that.
Yeah, no, the guy has a track record. record. So that was a real coup. He's been there about a year. He's been doing a lot of things, but a lot of the big initiatives are not going to show up till next year. You know, at the same time, Starbucks, the risk there is what's happening in the broader economy. We know there's still a lot of spending. It tends to be higher income spenders. The lower income, the whole industry, you know, in that space is seeing a little bit more competition. But this will be the year that will tell us. Fourth quarter, I don't think we'll see much change. But the risk reward, given where their stock is now, I think it's pretty attractive.
Good stuff. Always appreciate having you on.
Nice to see you, Charles.
All right, thanks a lot.